Unit 8 of International Finance, that is raising funds from international market. How we can raise funds from international market, we will discuss. Before discussing this, let me first tell you what will be the objective of my discussion. In this class, first we will understand how resources are raised in international market, how funds are raised in international market by Indian companies, and we will discuss different instruments through which funds can be raised. So let me first tell you the structure of my discussion. First, I will give an introduction to international fundraising. Then, in this context, we will discuss a concept called Euro issue. Next, we will discuss depository receipt or DRs. In DR, we will discuss regarding ADR and GDR. What is ADR? What is GDR? We will discuss. Then we will discuss something regarding FCCBs and ECBs. FCCB, ECBs. These are four important instruments we will discuss today. ADR, GDR, FCCB and ECBs. These are the instruments through which international funds are raised. Four important instruments we will discuss. Next, we will discuss what are the advantages and disadvantages of raising funds in international market. We will summarize our discussion. We will have some self-assessment question, and I will give some references for further reading on this subject. Let me first tell you what is international fundraising. Nowadays, in a globalized world, an Indian company can raise funds throughout the world. It can raise funds from USA, from UK, from Japan, from Germany, anywhere it can raise funds. Nowadays, fundraising is not limited to domestic markets only. Indian companies have choice to raise funds from different international markets. Now, why an Indian company requires funds from international market? There are two reasons. First reason is to meet the requirement of foreign currency. Why it requires foreign currency? Either for input or for expansion or for any other business purposes, it requires foreign funds. Next, to lower the overall cost of capital. What is overall cost of capital? The cost at which funds are raised. To lower it, we can raise international funds. Let's take an example. In Japanese market, funds are available at 2%, where in Indian markets, these are available at 8%. So an Indian company can raise funds from Japanese market. However, in this context, he will face some foreign currency risk or foreign exchange risk. In this context, first let me tell you a concept called Euro issue. What is Euro issue? Euro issue, we will discuss the concept called Euro issue. What is Euro issue? Now, please see, when a fund is raised from a foreign company, the funds can be raised. Suppose in USA, funds are to be raised. What is the currency of US? The currency of US is dollar. So, if you can raise funds from US in any currency other than dollar, that will be Euro issue, other than dollar. That is Euro issue. Let's take an example. In India, the currency is INR. Suppose a company raise funds from India, not in INR, but in some other currency. That is will be a Euro issue. So a Euro issue is a issue where the securities are issued in currency different from the currency of the country of issue, and securities are sold in international market, okay, to individual investors or institutional investors. So Euro issue is a type of issue where the funds are raised in a currency other than the currency of the country where it is issued. In USA, if you raise fund in yen or in pound, it will be a Euro issue. In UK, If you raise funds in dollar, it will be a euro issue. So euro issue clear. Euro issue means an issue made in a currency other than the currency of the country where it is issued, that is known as euro issue. Okay. Now a company can raise funds from international markets. In international markets, a company can raise funds either through equity issues or through debt issues. A company can go for international equity issue. It can go for international equity or it can go for international debt. Okay, international debt. If it goes for international equity, what are the options available to it? Either you can go for equity issue or you can go for debt issue. If you go for equity issue, you can raise funds, international funds, either through two important instruments. What are the two important instruments? First important instrument is ADR and second important instrument is GDR. So you can go for ADR route or GDR route if you go for international equities. Or if you go for international bonds, debt issue, there are different options. One is international bond. What are different international bonds? There are two types of international bonds. One is foreign bond. Another is euro bond. You can go for foreign bond or you can go for euro bond. Similarly, if you go for loan, international loan, it can be form of ECBs. What is ECBs? External commercial borrowings. So international equity can be obtained through ADRs or GDRs. International debts can be obtained through either international bonds or ECBs. What is international bonds? It can be of two types, foreign bonds or euro bonds. ECBs means external commercial borrowing. So first let me discuss the concept of depository receipts. What is depository receipt? Then we will discuss the concept of ADR and DGR. ADR means American Depository Receipt. GDR means Global Depository Receipt. So first we have to understand the concept of depository receipt. Now what is depository receipt? Let's take an example. Suppose Infosys is an Indian company. Okay, Infosys is an Indian company. It wants to raise fund from US market. Now Infosys can issue shares, but it is an Indian listed company. It can raise shares, issue shares in Indian market. But Infosys wants to raise funds from US market. US market means it wants to raise fund from US investors. How it can raise fund from USA investors? It wants to raise funds from USA investors and it wants to issue shares, but Infosys is not a listed company or registered company in USA. So what Infosys will do? Infosys will arrange or a US bank. Let's take an example. USA based bank is Bank of America. This is a foreign bank. And this foreign bank will act as intermediary between Infosys and US investor. What Infosys will do? Infosys will issue the shares to Bank of America, the foreign bank. What Infosys will do? Infosys will issue Infosys shares. Let's take an example. Infosys issues 5 lakh Infosys shares. What Bank of America will do? Bank of America will convert these shares to depository receipts. That means it will convert these shares to depository receipt. Depository receipts are derivative instruments whose underlying asset will be Infosys shares. So it will convert it to depository receipts. And depository receipts, how it will convert? It will convert as per its convenience. Let's take an example. It convert the shares into depository receipt on the basis of 1:5. What does it means? It means 5 share is equal to 1 DR. So there will be 1 lakh depository receipts. So 1 lakh depository receipt is equal to 5 lakh Infosys share. That means 1 depository receipt is equal to 5 Infosys share. Now these depository receipts are issued by whom? Issued by a foreign bank. What is its underlying assets? In the underlying asset is Infosys share. Am I clear? And these depository receipts are issued by Bank of America in the US market. How it will be issued in US market? It can issue it in OTC market. What is OTC market? That is private traded market. Private market. Privately it can sell the shares, or it can do it through an exchange. How it will do it through an exchange? It will do it through an exchange by listing these depository in receipts in some American stock exchange. It can be NYSE, or it can be in NASDAQ, anyway. Okay. So as these depository receipts are issued in US market, therefore it is known as American depository receipts, or these are known as American depository receipts, or these are known as ADRs. So where ADRs are issued? ADRs are issued by US banks. Where it is issued? To American investors. Okay, how it is issued? Through OTC market, through our exchange. Okay, now what is the underlying asset of depository receipts? Infosys share, or means non-US company shares. So what is American depository receipts? If the depository receipts are issued in US market, that is known as American depository receipts. But if Infosys wants to issue these depository receipts in any market other than US, then suppose it want to issue in UK market, then the depository receipts will be global depository receipts, or GDR. So the main point of ADR and GDRs are, ADRs are issued in US market, where GDRs are issued in any market other than US market. What is depository receipts? Depository receipts are derivative instruments. These are issued by foreign banks. The company which wants to issue shares in international market, they park their share with a foreign bank, and the foreign bank convert these shares into depository receipt on some ratio. Okay, if these depository receipts are purchased and sold in US market, those are known as American depository receipt. If these are issued in any market other than US market, those are known as global depository receipt. So if Infosys wants to issue shares in UK market, it will go for GDR issue, global depository receipt issue. If it is wants to raise money from Japanese market, it will go for GDR issues. But if it wants to raise money from US market, then it will go for ADR issues. Am I clear? ADR and GDR. ADR and GDR are depository receipts. Depository receipts are derivative instruments. These are issued by a foreign bank. The ownership of the depository receipt lies with the foreign bank. The foreign bank is the registered owner of this depository receipt. What is registered owner? इनके नाम पर होता है. The depository receipts are in the name of foreign banks. They are the registered owner of the shares, or they are the nominal owner of the shares. But they have converted the Infosys share into ADS and issued to US investors. So US investors really own the share, but not directly, but indirectly. US investors will be the beneficial owner. There are two types of ownership in depository receipts. One is registered owner, another is beneficial owner. Let me discuss the concept of registered owner or beneficial owner. You all might have watched the movie Three Idiots. Okay, and in Three Idiots, Amir Khan is the beneficial owner of the degree obtained by him. He enjoys all the benefits, but he does not get the certificate. The certificate is got by Ranchor Das Chanchal. He is the registered owner. Okay, all the benefits will be enjoyed by beneficial owner. If a Infosys will declare dividend, who will get it? Beneficial owner. But with whom, through whom he will get? He will get through the foreign bank, that is the nominal owner. So all the benefits of the share will be enjoyed by the real investors, beneficial owners. But the shares will be in the name of foreign banks. They will be nominal owner or registered owner of these depository receipts. So we are discussing the concepts of depository receipt. Depository receipts are issued by foreign banks, and foreign banks becomes the registered owner of the shares to be issued by a company, and the foreign bank convert these shares into depository receipts, which are derivative instruments. And these depository receipts, if are further issued, sold to real investors. If these depository receipts are further issued in US market, those depository receipts are known as ADRs. And if these are issued in any market other than US market, those are known as GDRs or global depository receipts. So there are two things, ADRs and GDRs. Let's discuss more on this concept, ADR and GDR. First, we will discuss the concept of ADRs. We have told that ADRs are depository receipts. We have concept clear, we have discussed it. And these are issued in US market. Okay. And when ADRs are issued in US market, they have to obey the rules, regulations of the American regulator. In India, like SEBI, in US, that the regulator is Security Exchange Commission or SEC. Okay. Now, If a company decides to go for ADR issue, it has to obey much more compliances which are given by Security Exchange Commission. Therefore, most of the company prefer to go for GDR, because in case of GDR, the compliance requirement are less. Okay. So, issue of ADR are costlier than GDR. In ADR issue, there are many costs attached. What are the costs? Legal fees, underwriting fees, road show fees, investor relation fees, registration fees. All these fees a company has to bear while issuing ADR. Through ADR, a non-US company can raise equity in US market. Okay. So ADRs are US dollar denominated instruments. ADRs will be denominated in US dollar. Why these are denominated in US dollar? Because these are issued by foreign banks. Foreign bank convert the share into dollars, dollar denominated ADRs, and these ADRs are negotiable instrument. They can be transferred from one party to another party. The ADRs represents the ownership in a non-US company's shares. Okay, the ADRs have to comply with strict requirement of Security Exchange Commission, and the company which issue ADR, they has to follow the US gaps. What is US gap? US generally accepted accounting practices. They have to prepare their accounting reports as per US gaps. Okay, ADRs have two-way fungibility. What is fungibility? The owner of the ADR, if once he can convert the ADR into shares. ADRs are of two types. They can be listed or not listed. ADRs can be listed in any US stock exchange. What are the US stock exchange? New York Stock Exchange or American Stock Exchange or NASDAQ. They can be listed there. Okay. Then depository receipts. American depository receipts are US dollar denominated negotiable instruments. These are issued by a US depository bank. What is a depository bank? The bank which play the role of intermediary is known as depository bank. He convert the shares, non-US company shares, into ADRs. It representing ownership in non-US securities. ADR provide non-US company to access US capital market. We know US capital market is world's largest domestic investor based capital market. Each and every company dream to raise money in US market. So they can do it by issuing ADRs. Okay. So we are discussing regarding ADRs. Now we will discuss some other concept regarding ADRs. The ADRs are first issued in 1927. Okay, in US market, the ADRs are first issued in 1927. Okay, ADRs are introduced because of the complexity involved in buying share in foreign country. With the help of ADRs, US investor can easily invest in non-US companies. US company investors wants to invest in non-US company shares. They can easily invest it through ADRs by subscribing to ADRs. Okay. The ADRs we have already discussed may be listed in New York Stock Exchange, American Stock Exchange, NASDAQ. Okay. The depository banks set the ratio of US ADR. What is ratio? I have told that one share, one ADR. or 5 share 1 ADR, they can fix the ratio. The ratio can be more than 1 or less than 1. It depends upon the American bank or foreign bank to decide the ratio of ADRs. Okay, the ADRs are also known as ADS. What is ADS? American Depository Shares. These are also known as ADS, American Depository Shares. Now, these ADR or ADS may be of three types. What are the three types of ADRs? There are first type of ADR is level 1 ADR. Next one is level 2 ADR. Next one is level 3 ADRs. There are three type of ADRs. We'll discuss this. What are these three types of ADR? Level 1 ADR, level 2 ADR, level 3 ADR. Level 1 ADRs are issued by all these ADRs are issued by US based foreign bank, and level 1 ADRs are not traded in US stock exchanges. These are traded in OTC market. What is OTC market? Privately traded market. Okay, these are not bought and sold publicly in a US based exchange. So the listing requirement in this case is not required, and compliances is very low in case of level 1 ADR. So level 1 ADR is the basic type of ADR. Okay, so all the companies do not qualify for level 2 and level 3 ADR. Those who do not qualify, they will issue level 1 ADR, and after issuing level 1 ADRs, the ADRs can be purchased sold in OTC market or privately. They cannot be purchased sold in US based stock exchange, and the listing requirement of SEC is also the minimum lowest in case of level 1 ADR. What is level 2 ADR? Level 2 ADRs will be listed in exchange or quoted in NASDAQ. They will be purchased sold in US based stock exchange. What is the difference between level 2 and level 3? In case of level 3, it will be issued through a public offering in US stock exchange. There will be public issue of level 3 ADRs. So in US market, the public issue will be made of level 3, and the trading will be done of both level 2 and level 3. And level 1 is OTC, and this is exchange traded. What is exchange traded? Level 2 and level 3 are bought and sold in an exchange. They are exchange traded, whereas level 3 is public issue. The company will bring public issue in US market. Okay. So what are the advantages of ADRs? We have discussed the advantages of ADRs are twofold. In this case, the US investors get an exposure to non-US companies. They can easily invest through non-US companies. Okay, and what is the advantages for issuing company? They get exposure to US investors. Okay, so we have discussed regarding ADRs, and the ADRs are the instrument through which a US investors can invest in a non-US company. Now one thing is there, suppose, please see, in case of ADR issue, there will be two things. One is investors, US based investor. These are the investors. They are the beneficial owners. And this is a company, Infosys. And there is a bank, that is depository bank. Okay, Infosys issues share and depository bank convert these shares into ADRs. The shares are issued and these are converted into ADRs. ADRs are denominated in dollar. Now Infosys will suppose give dividend. Infosys give dividend in what? Infosys dividend in rupees to which bank? Depository bank. Depository bank will convert these dividend into dollar and distribute to US investors of ADS. So depository bank will play the role of intermediary between the company and the US based investors. Okay, depository bank will be the registered owner and these US based investors will be beneficial owner. Am I clear? What is ADR? Next, we will discuss the concept of GDR. ADR over. Next, we will discuss the concept of GDR. What is GDR? GDR means Global Depository Receipts. What is Global Depository Receipts? If you want to raise international equity or issue shares in international market, but you do not want to issue your share in US market because the requirements are very stringent. You can go for UK market, Germany market, France market. You can issue your shares in those market. In that case, you have to arrange a foreign bank. The foreign bank will convert your shares into GDRs, and the GDRs will be listed in any exchange other than US exchange. Okay, so the GDR is a security issued abroad and it is listed and traded in a foreign stock exchange. The GDR holder can convert it into shares. GDRs are derivative instruments. GDRs are depository receipts, but these are issued in a non-US market. The GDRs or ADRs do not carry any voting right. The GDR holders or ADR holders do not have any voting right. Okay, and the foreign bank play the role of intermediary, and the foreign bank is the depository bank. He is the registered owner of the depository or GDRs. The depository convert these shares into GDRs. Okay, the GDRs are denominated in various currency. If it is issued in UK, the GDR will be denominated in Great Britain pound. If it is issued in Japan, the GDR will be denominated in yen. If it is issued in, let's take an example, Germany, it will be denominated in euro. Okay, the physical possession of equity share are entrusted with depository bank, and the depository bank normally appoint a person to keep the physical custody of the shares. This person is known as custodian bank. Okay, so GDR are issued in a non-US market, where ADRs are issued in US market. GDRs are used to raise equity capital. GDRs are used to increase shareholders' base. GDR increase demand and supply of the securities. GDR issue enhance the global image of the company which issues GDRs. And GDRs, in case of GDR issue, the depository bank play the following roles. The roles played by depository bank or foreign bank is, first one is issuing depository receipt. Foreign bank convert the shares into GDRs. It also helps in processing depository receipt. What is processing? If there will be transfer, maintaining of record, of registered holder, paying dividend, all this work will be done by the depository bank or registered owner. And it play the role of holding of securities. Okay, what is the cost of depository GDR issue? There will be many costs like ADR issues. The cost includes brokerage, underwriting commission, management fees, legal fees, travel and roadshow, printing stationery, listing fees, stamp duty, accounting fees, etc. etc. What is the procedure of GDR issue? Like ADS, the procedure is same. First, the company which wants to raise funds from any market other than US market, they will first issue shares to a foreign bank. The foreign bank will convert the shares into GDRs. The GDRs will then be listed in foreign countries stock exchange. Normally, GDRs are listed in Luxembourg stock exchange or Dublin stock exchange. These are the two major stock exchange where GDRs are traded. Okay, so we have discussed the concept of ADR and GDR. Now, can you differentiate between ADR and GDR? Yes, first ADR, then GDR. What is the main point of difference? ADR and GDR. First, ADRs are issued in US market, and these are issued in non-US market. These are subject to regulation of Security Exchange Commission. These are subject to regulation of the regulator of the foreign country. Regulator of foreign country. The company which issues ADR has to follow US GAAP. The company which issues GDR, they have to follow International Financial Reporting Standard, IFRS. And the issue is easy. Issue is difficult. Issue of ADR is difficult. And here it is comparatively easy. Compliance are stringent. These are less stringent. These are less stringent. ADRs are more liquid because investor base in US is very high. These are less liquid compared to ADRs. These are the major point of difference between ADR and GDR. Okay, ADR and GDR. ADRs are issued in US market, where GDRs non-US market. ADRs are subject to SEC regulations. These are subject to regulation of the country where these are issued. ADRs, company issuing ADR must follow US GAAPs while preparing its books of accounts, and the companies which issue GDR has to follow IFRS while preparing books of accounts. Issuance of ADR is difficult and stringent, and issuance of GDR is a comparatively less issue, and compliance are stringent. Here compliance are less stringent, ADRs are more liquid, GDRs are less liquid. These are the main point of difference between ADRs and GDRs. Okay. Next we will discuss if these are international equity issue. I have told there are two type of funds you can issue. First, you can either you go for, we have discussed, yes, you can go for international equity issue or you can go for international debt issue. If you go for international equity issue, you can go for either ADR or GDR. We have discussed ADR and GDR, how ADRs and GDRs play role. Okay. Next we will discuss international debt issue. What is international debt issue? Now, when you will go for international debts, there are two options available to you. First, you can go for international bonds. International bonds. The international bonds may be of first foreign bond, or it can be of euro bond. First, we will discuss foreign bond and euro bond, or you can go for external commercial borrowings. ECB. So first we will discuss the concept of international bonds. Bonds are long-term instruments. These are long-term debt instruments. Suppose Infosys wants to raise money in form of debt from US market. So there are two options available to him. One is foreign bond, another is euro bond. What is foreign bond? What is euro bond? Now please see, foreign bonds are denominated in the same currency where they are issued. It means if a company wants to issue bonds in US market, what is the currency of US? The currency of US is dollar. So if you issue dollar bonds in the US market, that is a foreign bond. Dollar bond in the US, that is a foreign bond. Okay, dollar bond in US, that is a foreign bond. And dollar bond in US is known as Yankee bond. Similarly, what is the currency of Japan? The currency of Japan is yen. So yen bond in Japan is a foreign bond and it is known as samurai bond. What is the currency of China? Yuan. Yuan bond in China is a foreign bond. It is known as panda bond. PANDA. Similarly, in India, if a foreign company wants to raise bond, what is the currency of India? Currency of India is INR. INR bond in India issued by a foreign company. That will be foreign bond for him and that is known as masala bond. So foreign bonds clear. What is foreign bonds? Foreign bonds are issued in a foreign country in the currency of the country where it is issued. But if it is issued in some other currency where it is issued, that means in USA you raise pound bond. Pound bond raised in US market, that is a euro bond. What is a euro bond? Euro bond is not denominated in the currency in which it is issued. If in Japan you will raise dollar denominated bond, dollar bond in Japan, it is a euro bond. So euro bond, what is euro bond? We have discussed. Euro bonds are denominated in a currency other than the currency of the country where it is issued. Foreign bond, euro bond, clear. Next, we will discuss In case of foreign bonds or euro bonds, there is a concept called FCCBs. What is FCCBs? Foreign currency convertible bond. So we will discuss something called FCCB, foreign currency convertible bonds. Next we will come to ECBs, external commercial borrowing. So first we will discuss FCCB, foreign currency convertible bond. What is FCCB? As the name suggests, FCCB is a bond. Bond means debt instrument, but it is a convertible bond. What is convertible bond? Convertible means it can be easily converted into shares. So FCCB is an equity linked debt security. It is a bond, debt instrument which can be converted into equity. Therefore, it is a equity linked debt security. It can be converted into shares or depository receipt. And these instruments are denominated in foreign currency. Therefore, it is known as foreign currency convertible bonds. These are international bonds denominated in foreign currency, but these can be converted into shares at the option of the shareholders or of the option of the bondholders. If the bondholder want, he can convert the bond into shares after a particular point of time at a rate which is prefixed by the company. So in this case, the investor has an option to convert the bond at the market price of the shares, okay, at a predetermined period. So FCCBs are bonds which are convertible into equity shares at a predetermined price at the option of the investor, but after a certain period, normally 1 to 2 years after issue, if it can be converted, if the owners want of the bond want, it can convert it into shares. Normally the maturity of these bonds are 10 to 12 years. Normally FCCBs are listed in London Stock Exchange or Luxembourg Stock Exchange. Normally these are bearer securities which are having put and call option attached to it. So we have discussed FCCBs, foreign currency convertible bonds. Next we will discuss another concept, that is ECBs. What is FCCB? The foreign bonds or euro bonds can be of FCCB nature. Foreign currency convertible bond, these two are of FCCB natures. Okay. Next we will discuss ECBs. What is ECB? External commercial borrowing. So we will discuss now ECBs, concept of ECB. Now we will discuss the concept of ECBs. ECBs, external commercial borrowing. As the name suggests, these are commercial borrowings. Commercial borrowings means these are loans. But the loans, company take loans not from domestic market but from external market or foreign markets. So ECBs are commercial loans. These are commercial loans. These may be in form of bank loan, buyer's credit, supplier credit, securitized instrument, any loan. And the loan can be of floating rate loans or fixed rate loans. And available for non-resident lenders with a minimum maturity period of 3 years. In case of ECB, there can two routes, automatic route, approval route. What is automatic route? So in case of ECBs, the automatic route, if the ECBs are of automatic route, then a person can take these loans without approval. In India, the approval will be given by RBI. for ECBs. Okay, without approval of the regulator. Regulator here is RBI. But approval route, they have to first take the approval, then they will go for ECBs companies. Approval of RBI is a precondition. So ECBs means external commercial borrowing. You can take foreign loan. From where you can take foreign loan? You can take foreign loan from commercial banks, from buyer's credit, from supplier's credit, from securitized instrument. You can go for or export credit agencies. You can take loan from multilateral financial institutions like ADBs, etc. You can go for either automatic route or you can go for either which route? Approval route. What is automatic route? In this case, the approval of RBI is not required. Normally, automatic route ECBs are available for 1-2 sectors. What are the sectors? Industrial sector and infrastructure sector. These are the two sectors where automatic route is applicable. Okay. And what are the, in all other sectors, you have to go for which route? You have to go for the second route. What is the second route? Approval rate. Approval route is required. Okay. For all other sectors like financial sectors, banks and financial institutions, they have to go for approval route. So these are two forms. Now we will make a comparison between three ways of raising funds in international market. What are the advantages and disadvantages? If we go for ADR, what are the advantages? What are the disadvantages? GDR and ECBs. These are the three things. First, ADR. ADR means American Depository Receipt. Next, we will discuss regarding GDR, Global Depository Receipt. Next, we will discuss ECBs, External Commercial Borrowing. What are the ideal situation in which ADRs will be used? ADRs will be used if you have large current future needs. Your future needs are large, then you will go for ADRs. And it involved international industry. If your industry is international nature, you will go for ADRs, and ADRs issue is the most stringent one. But you will get the benefit of broader investor base, which is US based investor based, and you can charge premium price and it increase the prestige of the issuer. What are the, it provide best liquidity, okay, and it is more stable market, and it provides maximum flexibility. What are the disadvantages here? The disadvantages is extensive disclosure requirement. The disclosure requirements are very high, and you have to prepare your accounts as per US gaps. I have told you have to follow US gap mandatorily, and your issue cost will be very high. These are the disadvantages of ADR issue. Next, we will discuss GDRs. What are the ideal situation where you can go for GDRs? Ideal situation GDRs. First, if you require specialized fund and your company is a regional based company, you are not a frequent visitor to international capital market, but you require some funds occasionally, you can go for GDR issue. The disclosure requirement will be very low. These are the advantages. Stringent, not so stringent like ADS. Okay, and the issue can be made very quick. low issuance cost than ADR, and it can be raised quickly. But what are the demerits or disadvantages? Disadvantages are more limited resources, and the liquidity is low in case of what GDR issue, and you cannot get high valuation of your company. Next one, the last one, that is ECB's external commercial borrowing. When you will go for external commercial borrowing, you can go for external commercial borrowing where it is ideal. It is ideal where there is fast rising of stock prices, and you do not want go for equity issue. You have a tremendous growth prospect in your future. And what are the advantages? You will take a loan now, and in the future, you will sell equity at a premium price. And you will have an incremental investor base. As you take loan, your control is not diluted. Dilution of control is less. And ECBs can be raised within shortest time frame than ADR and GDR, and issuance cost will be low. And what are the disadvantages of ECBs or external commercial borrowing? There is a limited access to US capital market and low level of liquidity after conversion. These are the major advantages, disadvantages of these three instruments. So let me summarize my discussion today. We know that international nowadays companies, Indian companies are increasingly tapping to international financial markets for raising funds. There are four important instruments through which funds can be raised. One is through equity, international equity, that is through ADR and GDR. Another is through international bonds, that is through ECBs or FCCBs. ADR means American Depository Receipt or Global Depository Receipts. These are the two ways of international equity raising. And ECB, FCCBs are international bonds. Although there are significant difference between these instruments, normally if you want long-term funds, you will go for ADR and GDR. If you want long-term debt fund, you will go for international bonds. If you want long-term, short-term funds, you go for ECBs, external commercial borrowings. Okay, so we have discussed the international bonds, international equity issues, international bond issues. So what are the self-assessment questions? First question, discuss the objectives of raising resources from international market. We have discussed the trends of euro issues, and examine ADR and GDR and its issue guidelines. What do you mean by ECBs, external commercial borrowing? How ECBs can be issued? Okay, and make a comparison between ADR, GDR, and ECBs. And these are certain further reading materials. Okay, and you can follow these books for knowing more on ADR, GDRs, and international issues. And these are certain web references which you can visit to know more regarding international issues. Thank you. Thank you for attending my class. Thank you. Thank you all.